Thanks for joining us at XM.com for today's market comment by Haralambos Pisuros. I'm Cristina Marujos. The US dollar slid against all but one of the other major currencies on Friday, but it is showing signs of stabilization at the start of this week. What prompted dollar traders to liquidate their long positions on Friday may have been the lower than expected jobs growth for July. The U.S. employment report revealed that the world's largest economy added a lower than forecast 187,000 jobs, a number accompanied by downward revisions in the May and June prints. Although the unemployment rate ticked down to 3.5% and average hourly earnings grew by more than anticipated, investors were not tempted to raise bets that another hike by the Fed may be required. Alongside the U.S. dollar, U.S. Treasury yields pulled back as well. The next big test for the greenback may be the U.S. CPIs for July, due to be released on Thursday. An upside surprise may prompt market participants to reconsider the possibility of a hike in September and scale back some of their rate cut bets, which could help yields and the dollar rebound again. The Canadian dollar was the only currency against which the dollar did not lose ground. This may be due to the Loonie weakening more after Canada's jobs report revealed that the economy lost 6,400 jobs in July, solidifying investors' view that the Bank of Canada is unlikely to raise rates at the upcoming meeting. Although it enjoyed 2 days of gains on Thursday and Friday, the Japanese yen is on the back foot again today. At the beginning of the day, traders got the summary of opinions from the latest Bank of Japan meeting, in which it was revealed that policymakers debated growing prospects of sustained inflation. Despite this view implying that officials may be now more willing to further phase out stimulus in the coming months, the yen did not extend last week's recovery. Wall Street jumped higher after the U.S. employment report. However, equity investors were not willing to close the week with increased risk exposure, liquidating some of their positions and forcing all three of the main U.S. indices to tumble again and extend their prevailing correction. Although increasing Fed cut bets are positive for stock markets, both the technical picture and valuation multiples point to a market stretched to levels at which only very few will be willing to buy. Therefore, a decent correction at this stage appears more than justified. However, calling for a bearish trend reversal now seems premature and unwise. In commodities, gold traded somewhat higher on Friday, although it is surrendering those gains today, while oil prices extended their recovery, which is mainly driven by the pledge of major producers like Saudi Arabia and Russia to keep supply subdued for another month. This was today's market comment at XM.com. Have a great week.